And welcome back to another Pivot podcast. So glad you can be with us again today. Once again, I'm joined with my amazing co-host, Mr. Dan Jansen. How are you, sir?
I'm doing awesome. How are you, Tracy?
I am spectacular. Just got back from a wonderful trip on the island. Completely life-changing. And I'm just ready to get back at her.
I'm so jealous of your trip. I got to make it out to BVI as well, but didn't make it this time. But yeah, so happy for you. That's awesome. I know everybody that goes to BVI has an incredible experience. So they always come back refreshed and just different mindsets.
Yeah, if you ever have a chance to go, it's well worth it for sure.
Yeah, absolutely.
No, absolutely.
For this episode, and again, it just seems like when we talk about episodes, we're planning it out way in advance, but this market is getting a little volatile, and that's the topic for today is how to identify and really take advantage of volatility, and when the best time of day or week or month it is to really utilize volatility on certain trades and style of trading, because things can be a little different based on market conditions. So obviously, if there's not that much volatility, there's certain styles of trading that works better than others, and volatility is specifically for day trading purpose that's what you need. You need some kind of volatility and price movement to really make money day trading. Mm-hmm. But I guess we should start with the beginning of what would you say volatility is?
Well, I think volatility could easily be defined as how big of a movement price-wise does a stock make. So a stock that makes large swings in price, particularly intraday, that's going to have a bigger volatility. That's going to represent more volatility than something that makes very small moves in the day. That's really, I guess, the basics of it. But
we had an episode where we talked about the caps and things like that. Is small cap better for volatility? Large cap better for volatility? Mid cap? Does it make a difference?
That's a great question. And honestly, I think there's certain industries that show up with more volatility than not, like the visas and things like that. They have a tendency of just being slow growth. They just kind of just trend up. They have very low volatility. Ford seems to have low volatility. These are just that come off the tip of my tongue. But the tech sector, for instance, high volatility. Now, that might change as interest changes in different sectors, because the volatility is driven by fear in the markets. That's really what comes down to it. So if there's an event that's happening in the overall world that's going to affect the markets globally, that's going to increase some fear, which is going to increase volatility as people are trying to get in, get out, protect themselves, do all sorts of different things, or they're uncertain of which direction the market's going to go, and that's going to increase volatility. So to answer your question, I'm not 100% sure whether a small cap, large cap would make a difference. Do you have an idea? Oh, I should say this. If you've got more liquidity in the market, that's going to help slow that volatility or keep that volatility under control more than something that has less liquidity, because that lower liquidity is going to, I guess, make those ranges a little bit easier to attain, right?
Yeah. I think every stock is vulnerable to volatility. Mm-hmm. So when we're talking, as you mentioned, like the larger caps, the Coca-Colas, Kraft Heinz, Visas, like the companies that have been around forever, especially dividend-paying companies, they're a lot of times in a lot of major portfolios, a lot of different 401ks. There's those positions are sitting inside those mutual funds, things like that. But so therefore, those guys have a different set of rules that they're trading with, where they're not buying, selling in and out for the most part for a lot of those bigger retirement type funds. So they do move a lot slower. I think a lot of the retail stocks or retail capable stocks will typically have more volatility. Like you mentioned, anything in the tech sector, you do have a lot more volatility in. But you could have small cap volatility. You could also have some of the bigger Fortune 500 companies or large cap companies that are vulnerable to it as well. But those would have to be based off news. So if there's any kind of news that independently affects that company, When we typically see world events, we have the Russia Ukraine war going on right now. I think that's going to cause some volatility, extra volatility in the overall market. But I think a lot of those other bigger companies are still seen as some kind of safety play. So if you're in the market, everything is going great. It's year right after COVID to almost 3-4 months ago, the market was just rocketing. People have a more risk on type atmosphere.
Mm-hmm.
So in those type of cases, they're going to they'll feel a little bit more comfortable taking advantage of some of maybe the smaller names, some things that have good potential speculative growth to it, because other people are piling in, and it's all based on supply and demand. So the demand increases, people get FOMO, they start jumping in. A lot of the larger companies during that time frame, relatively, they'll still move, but not quite as much. So you're not going to be able to really take advantage of full day trades. Mm-hmm. Swing trading is a little bit different. Obviously, you can still take advantage of some swing trades on some larger companies, but you have volatility. When volatility is high, for me at least, I think that's a perfect market for day trading. Swing trading could be a little rough because you don't know exactly how the market's going to open. I mean, we've seen the last 2-3 weeks in the market where it looks like the day is running completely bullish. Next day you gap down. Next day you're gapping up. So it's all news dependent, and it makes swing trading a little bit tougher. Mm-hmm. But for day trades, yeah, you have a lot of intraday movements, wide ranges, and that's what you kind of need for when you're day trading.
Mm-hmm. I'd like you to just quickly explain what you mean by risk on for our listeners.
Yeah, 100%. So there's risk on and risk off. That is when it's risk on, the market's kind of moving bullish. You're bullish or bearish in a certain direction. But when it's risk off, you have typically high volatility. So like I said, the last 3 weeks of the market where you really don't know what's going to happen because the market is opening in random places, closing random places. You're trapping bulls, bears on both sides pretty much from one day to another. So in those type of situations, that's going to be a risk off type trade because a lot of people don't want to sit there and gamble the stock market, right? They want to say, here's a good company. I like it. I'm going to invest in it. You have your risk on, you're pushing your portfolio 80% in the market, 90% in the market, but risk off, a lot of times you're sitting on cash. You're just waiting for the market to complete its volatile move and waiting for a better, more stable market. So once some of the headlines clear up, once the inflation goes down, the Fed comes out, you kind of anticipate currently how they're going to move. You're able to make your moves based off that, add some money to the market, and have that risk on type situation.
So that could be represented by taking less trades. It could be represented by trading in more stable stocks, for example, or even going into say some of the bills or the bonds, some of those types of markets, or even getting into some of the metals. Like a lot of people
gold,
like to invest in gold. Yeah, exactly.
Absolutely. Okay. So yeah, those type of moves, they're more safety plays for a lot of longer term guys.
Fair enough. Now, what are some of the ways that you would be able to identify volatility increases in the market?
So the one thing that I personally look at is the VIX. So it's VIX is the ticker. That's going to be your volatility index. If the market is skyrocketing high and just every single day it's just up, a lot of times there's not that much fear in the market, so there's not that much volatility. So in that certain case, you typically have good follow-throughs and you're making steady gains, and that would be the risk on type of atmosphere. As the market comes down, people aren't afraid to make money. They're afraid to lose money. So when the market comes down, that's when you have the entire market freaking out. You have retailers selling. You have bigger whales in the market. They're trying to get out of positions. I think I read a report probably last week that a lot of the bigger hedge funds have been exiting the market based off of any of the recent pops that we've had. They've been looking to take money out. Where you have, on the other hand, you have a lot of retailers that are actually coming in to buy the dip, right? And it's worked for the last year and a half as far as just any dip, buy it, and it goes up. But now I think you're starting to see a little rotation. So a lot of the bigger guys, they're selling their shares to the retailers, and retailers are just kind of going back and forth. So, and for some of these bigger guys, it's better just to sit on the side, wait for the opportunity, and then once they spot what they're looking for, they'll jump back in and be risk on again. So, but I'll use the VIX when the VIX starts pushing up higher or starts breaking out of certain pivots. Then that typically means that there's a lot more volatility in the market, and it might not be such a great environment for some of the swing trades. Long term is still okay but that would be the time to look to hedge some of the long term, buy some puts, protect yourself on the way down, because who knows what's going to happen in the market. It's pretty much all over the place.
Mm-hmm. Now, just for our listeners that don't know what the VIX is or how it's calculated, we won't get into the math behind it, but really, the VIX is a representation of options buying and selling, and options are insurance that people typically buy. I mean, you can use it to trade, but that's what it was designed for, is insurance to hedge against a position. So when a lot of people are starting to hedge their long positions by buying puts, for example, that's showing a sign of uncertainty in the market, and that's what causes the VIX to rise. So the VIX, when you're getting in around the 30 mark or above the 30, that's typically high volatility, and down below 20 is typically low volatility. At least that's my understanding. Do you have anything to add to that?
I'm the same way. Yeah, I like. We sat, and I'm looking at a weekly chart right now, but we sat in the 15 to 20 range from 322 of 2020. So that right after the COVID spike, we just kind of sat very low with the VIX, and we saw the market just skyrocket to all-time highs.
Mm-hmm.
And then recently you're starting to see some spikes, and currently we're sitting around 31.77. So it's getting to a little bit of the high side, but yeah, I like anywhere between really 10 and anything under 20 for the VIX to be a low volatility market.
Mm-hmm. Absolutely.
Which is a little bit more stable at that point. But yeah, once you start really breaking out, and the VIX could go nuts again, depending on how the market moves, what headlines are out there, how much uncertainty is out there. You've seen, I mean, I'm looking at a spike right now that was $85, just absolutely killing the markets. So the VIX is very tough, I think, personally, to invest in. I would only personally buy the VIX itself for something on like under $15, and that's just me. For if I actually want to trade the VIX, but otherwise I'll use that as an indicator. Is especially during the day too. If you're watching the market start to go up, let's say you're day trading, and you look at the VIX, and the VIX is starting to pop a little bit too, it's a good chance that market might be topping out, or look to push your stops up a little bit, take targets earlier, just because it's typically a sign that things are going to start rolling a little bit to the bearish side.
Mm-hmm. That's thank you for bringing that up, because I was actually going to ask you if you trade the VIX. I don't trade the VIX, but I was going to ask you that. So good. Do you ever use option pricing to determine volatility at all?
I don't do that as much. No,
me either.
For the most part, because there's a couple of things that go into the option pricing. I know people use it for that. It really comes down to how much premiums on both sides, the call and the put. But for me personally, it's just a lot of information for me to. The VIX for me is just a lot easier to look at and just understand where we're at than for me to go through option contracts, as I'm also trying to day trade and things like that. So I try to keep things as simplistic as possible for an overall general look of things. Yeah, usually when the premium on calls and puts are both relatively high, you're sitting in a very volatile market.
Mm-hmm. And when volatility is high, that's the time when you're wanting to sell options. And when volatility is low, that's when you're wanting to buy options, which is why volatility has a tendency of going up right before earnings. And that's the best time to be selling options, right before earnings, and then buying them after, kind of thing.
Yeah, and that would be a little more company specific.
Yeah.
Obviously, for which company is reporting earnings, but it's the same type of deal. I mean, typically before earnings come out, especially in a normal market, really, if you're buying options for that company about 2 weeks prior, even if the stock is just kind of flat, a lot of times you'll see the premium start to creep up, and then you can sell your options, because typically they'll be more valuable right up to the day of the earnings coming out, because you're sitting there in a position where, again, you you don't have any certainty as to which way the earnings are going to come out. Are they beating? Are they missing? Are they in line with expectations? So there's a lot that goes into it. And once you have the uncertainty, that's when that volatility would pick up. But the VIX obviously is going to show a little bit more for the generalized market as opposed to an individual company.
Absolutely. And I don't want to focus too much on options, but I do want to mention something else because we are talking about volatility. And I would like you to define Volatility Crush or IV Crush.
So IV Crush is really... IV Crush is when the premiums on both sides, especially, so we'll just go back to the example of earnings. If a company has earnings coming out, the premiums on both directions are typically going to get jacked up. So people buying those calls the day of, thinking like, hey, this Facebook is going to run $20 or whatever the case. It might, but a lot of times what happens is it's already priced into those contracts as far as where they're expecting the stock, like Facebook, to move. And unless it's really clearing those certain pivots, it's very hard to get paid on those. And then what happens is the next day opens up, those contracts are live again, and the excitement is out of the market for that stock. We already know kind of where it's at, and people that overpaid, they paid the extra price for the volatility of those, and instantly, pretty much both sides, the calls, the puts, they're beaten up on as far as the pricing of those contracts go. So it is tough to buy. It's tough to buy options really leading into it. I would say the day before, but really leading into those earning reports, it gets a little tough because you're very much victim to getting some of those volatility crushes.
Mm-hmm. Absolutely. So, I mean, the stock could be exactly in the direction that you wanted to go and above your strike price, but that volatility will just kill you and you end up in a losing position anyway. So something to be aware of, especially when playing options.
You could be looking at a company that is, I mean, you're just looking at plain options, calls, puts, and you're like, all right, if I'm going to buy it, but what you might not be seeing if you're not a regular options trader is they're already pricing in a 7-8% move on that stock.
Yeah.
So unless that stock is now pushing 10 to 15% or higher in whichever direction, you're not really going to see too much of that profit as far as the actual stocks go, the options go.
Yeah, exactly. Now, for me, my biggest, I guess, representation of volatility, I trade the same stock most of the time. In fact, I trade AMD just about every single day, but I trade the Qs, Tesla, Apple. I'm very familiar with the stocks that I trade. And when there's low volatility, and I'm just going to throw out some numbers, this isn't exact, but if I'm trading AMD in low volatility, say I can get 1,000 shares when I normally put on a trade. And that's because I place my entry and my stop at specific locations. It's not a set 25-cent stop or a $1 stop or anything like that. This is where it makes the most sense for my stop to go, and this is where my entry goes. So let's say that I can get 1,000 shares based on low volatility. And then all of a sudden I'm starting to trade on the same minute chart. But now when I place my entry and my stop, I'm down to like 200 shares. And that's because the actual span of a 2-minute candle has increased so much. It's covering so much more distance than it was in low volatility. When I start to see that share size really dwindle based on the way that I trade, that is a representation to me that there has been a massive increase in volatility. And I need to adjust how I'm trading, adjust my expectations, start taking more at my targets, etc. So that's kind of the gauge that I'm using to adjust my trading intraday from day to day to day, right? And it's actually one of my concerns about setting trades with set stops, because if you're not aware of those increases in volatility, you may get used to trading with, say, a 25-cent stop, but all of a sudden that increase in volatility and you're not covering that stop movement, it can move $1 in that one thing. So now you're all of a sudden getting triggered into a trade and immediately stopped out, and you're going, what the heck? What's happening? And you start to go down that little psychological spiral of poor me. Why am I such a bad trader, right? And you're trying to recover from that. So
yeah, and you're spending the rest of the day not in clear mindset that maybe you might have started the day with. So yeah, I get it. I never thought about that, but that is true. I never compared that to volatility, but yeah, if you're seeing normal candles or even I mean, even if you're pulling up the average true range of stocks,
Hmm.
and AMD for a while had, I think it was like a $3 average true range throughout the day. And I think right now the average true range is roughly $5-6. Like it's grown pretty massively in the last couple of weeks. And by using something like average true range and knowing the stock and the personality of the stock and how it trades, you're getting an idea like, okay, there's a lot more volatility now in whether it's just, again, company related or just the overall stock market. But for whatever reason, these particular stocks that you might be trading are, they have bigger swings in either direction. So you got to kind of prepare for that as
Hmm.
well.
So we've touched on a little bit of why that would be important for you to know. Why is volatility something for us to pay attention to? One of them that, like I said, that I personally like to know is for my stops and my targets and making sure that I've got a stop in a decent place that's not going to get wicked out because of volatility. But what are some of the other reasons that we would want to know about volatility? Any advantages, disadvantages?
Yeah, I mean, the one thing that you have to, I'm not saying for you, but for maybe somebody listening, a newer trader or somebody struggling, if you were sitting there in 20, like after March of 2020, and you were just absolutely crushing the markets up until 3-4 months ago, and all of a sudden you're struggling, your plan itself that you might have had, it doesn't mean the plan is broken. It just means that the market might not be working with your plan. The volatility is increasing.
Hmm.
So you might have to tweak things in your plan or kind of figure out, back trade a different, more volatile market with your plan and have to make those adjustments. Because, again, if you're trading AMD throughout the course of 2020 to a couple months ago, realistically, your trade setups are going to change. How you wait for your entries might change a little bit. You might not be using the same average true range as before. So just kind of looking and understanding the how your plan actually works in the different market conditions is super helpful for how you can be consistently profitable in the markets. And you'll also be able to identify which plan you should kind of be working on, or which setup. Maybe a certain setup that you were taking worked incredibly high percentage amount of times in last year, and that might not be the case anymore. And again, I think you kind of alluded to, is maybe back in 2020 you could sit there and try to get a little bit more from your trades,
Hmm.
right? But because volatility is in the market, you might want to try to stack some wood, try to get a 1.2 as opposed to a 2.4, right?
Hmm.
And it doesn't really affect how much money you're going to make in a certain day or week or month, but it's going to help keep you safe in the market as far as your trading plan. You're not sitting there, trying to hit 2 hours and all of a sudden you're coming back for negative half an hour,
Hmm.
right? And it could happen just because of the wild swings that you'll see, not even on a day-to-day basis, but even intraday that you might be trading. The other thing too is I would look for is again, so which market condition, the one that works best for me in volatile markets is day trading.
Hmm.
Be in, be out. I don't want to I don't want to have risk on type feeling right now. I want to go to sleep, not care what the market does, open up bearish, positive. I'll just trade it how it is. So I want to, for me, I take a lot less day trades in the last 2-3 months than I was in 2020. 2020, I could sit there and if it's trending, it's trending. If I get stopped, I get stopped. But
You mean
a
swing
lot of those
trades?
trades were working.
Took a lot less swing trades?
Yeah, I
Yeah.
haven't taken a swing trade in, for me personally, probably 3 months.
Yeah. Yeah. Gotcha. Gotcha. Now, do you primarily trade the open or do you trade later in the day?
I'll trade the open and throughout the day,
Yeah.
but you'll also see with high volatility that opening range changes. So again, back probably about 9 months ago, 12 months ago, something like that, you could take an opening range trade and the risk to reward made sense. A lot of times right now, and I'll still take some if I see something I like or a good gap or something like that, that would still, if you're still playing the sentiment of the market, you're still able to at least pick the right direction. But the real issue right now is because it's so volatile, the open is even more volatile, and you're getting larger candles. Your setups are you need those stocks to run a lot more for it really to make sense on a risk to reward basis. So yeah, I'll take opening trades, but those have slowed down too, just based on solely risk reward. I'd rather get a tighter setup for me.
Mm-hmm. I completely get it. And that was actually one of the things that I wanted to bring up was, opening or the open, trading the open is always volatile, always, which is why it's very difficult for a lot of new traders to not get run over during the open. But yeah, when the global markets are volatile, it just increases that volatility even so. That being said, when you have high volatility like that, I pretty much guarantee there's going to be another trade setup that, like you said, will have better risk reward later on if you're just a little bit more patient.
Right.
Or you can end up taking multiple trades because you take one trade in the morning that sets up quite nicely, and usually in the afternoon the volatility sets up for another trade with some decent risk reward as well.
Right.
Yeah, for sure.
Yeah,
now,
it's just all about understanding the market condition that you're in.
Absolutely. So if you guys have any questions on volatility, shoot us a question. Shoot us a message in either on Twitter at RLT or at RLT Pivot or at Pivot. I'll put the link in the description below. I can't remember what our ticker is. But yeah, so shoot us a message in Twitter or just email one of us, Tracy at reallifetrading.com or Dan at reallifetrading.com. And again, all the links are in the description. But Dan, we've got that competition still going. Do you want to just do a little touch base on that before we?
Yeah, we've had a lot of response to the competition so far. We've had a lot of submissions already, but we do have, if you have not and would like to participate in the competition that we're running, it is for this month. You have up till the 31st of March to get your submissions in. What we need for you to email, again, Tracy at reallifetrading.com or Dan at reallifetrading.com, is your trading plan and also your why as to why you're trading the market. So again, the purpose of this competition and the prize, you do get a mentorship with myself and Tracy, or one-on-one coaching with myself and Tracy for a future episode of the Pivot podcast. But for even if you don't get chosen for that, the idea is as we progress throughout the year, we'll have different challenges, different levels that will inherently make you a better trader, get you a more solid foundation as you're going pretty much month to month. So once again, if you guys have not submitted, make sure you guys send us an email and include the current trading plan that you guys have and also the whys. And we can also discuss those at a certain point as well, just to kind of recap some of those trading plans that come in.
Absolutely. That about wraps it. So we'll see you next time.
We'll see all you guys. Thanks for tuning in each and every week. You guys are incredible. We will see you on the next Pivot podcast.